€1.99 free. Neobrokers like Scalable Capital or Trade Republic promise you free investing, yet make millions from your trades. We all love getting things for free. It feels like a win. But these companies have hundreds of employees, big offices, and expensive IT to run. So how can they possibly be free? Here's the truth. They're not. And guess who's paying the bill? You are. They take money straight from your account in ways that you don't even know. That's why the EU wants to ban their business model as early as 2026. Let's break into the hidden costs that eat into your returns. Because in investing, there's no such thing as a free lunch. Let's start with the first hidden cost, the so-called bid-ask spread. Sounds technical, but it's actually pretty simple. Almost every investment, shares, ETFs, gold, has two prices, not just one. Think of it like an auction. The bid is what a buyer is willing to pay. The ask is what a seller wants. The difference between them is called the spread, the built-in cost of trading. That's why the moment you buy a share or ETF, you're already a little bit in the red, because you bought at the higher ask and you could only sell for the lower bid. Let's look at an example. You could buy this ETF on Lang & Schwarz for €104.12 ask, or sell for €104.11 bid. Just a 1 cent spread. On GetX, it's 2 cents. Spreads are usually tiny and you can ignore them, unless you trade with a neobroker. And here's where it gets interesting and a little uncomfortable. Neobrokers like Scalable Capital or Trade Republic may not charge you a visible commission, but they still profit from the price you trade at. Because they don't just connect you to the market, they decide which market you get, because of payment for order flow, which we'll talk about in a moment. And since a spread of a few cents doesn't make much money, here's an example what they do. While the normal spread should be 3 cents, Trade Republic charges you €4.38. That's 14,500% higher than it should be, and it comes straight out of your pocket. The good news? You can reduce the damage even with a neobroker. Trade European shares during peak hours from 9 to 5:30 when activity is highest and spreads are the tightest. For US stocks, trade in the afternoon when Wall Street is open, and use limit orders instead of market orders. That way you control the maximum you'll pay or the minimum you'll accept. Just remember, the trade might not go through if the market moves away from your price. Earlier I said your neobroker decides which market you get. Remember that? It's called payment for order flow. When you place a trade, neobrokers often don't send it to the exchange that would give you the best price or the smallest spread. No, they route your order to a so-called market maker, a company that's always ready to buy and sell. The market maker earns money from the spread and shares part of that profit with your broker. That's why the EU plans to ban this in 2026, following the lead of several other countries. Why? Because it creates a clear conflict of interest. Your neobroker and the market maker both want to make money from your trade. And with a tiny 1 cent spread, there's barely anything to earn. That's why market makers can nudge the spread in their favor, meaning you'll end up with a worse price than you might get elsewhere. For them, it's not just about executing your trade, it's about monetizing it. You can limit the damage by trading during peak hours, using limit orders, and comparing execution prices across brokers. But as long as payment for order flow exists, the incentives are stacked against you, which is exactly why regulators want it gone. But payment for order flow is not their only side income. They can also get kickbacks or commissions from third parties, of market makers or ETF providers. Here's how it works. When you buy an ETF, the provider might pay your broker a thank you for bringing you in as an investor. And since that payment comes from the ETF fees, it's ultimately your money. Kickbacks rarely appear in your neobroker's app. You have to dig into the ex-post cost information to see the real picture. One of you guys actually sent us his numbers for 2024. Trade Republic claims he paid 25 euros in trading fees. But when we checked the ex-post statement, the total was 3,375 euros. That's 13,400% more than he thought. And with a total trading volume of just 11,500 euros, it's nearly 30% of his investments that went straight to fees. That's insane! The danger is obvious. You might think you're picking the best investment when you're really picking the one that's best for your broker. Always compare similar products, especially ETFs, not just the first one in your broker search results. And if you want personal, unbiased help choosing the right investments, you can book a free meeting with us using the link below. The next hidden cost hits every German investor, even if you never used a Neobroker. What if I told you there's a tax that can hit you even if your investments go down in value? Sounds crazy, right? But in Germany that's exactly what can happen, and it's called Vorabpauschale. If you own a distributing ETF, Finanzamt takes its taxes every time you get a dividend. Fair enough. But with accumulating ETFs, they might otherwise have to wait years, even decades to collect taxes. Well, not anymore. If you hold an accumulating ETF in a regular brokerage account, Finanzamt calculates your ETF return each year and taxes you on it, even if you didn't sell, even if the gain is just on paper. And if you pay taxes on fictional profits this year and the market crashes next year, you don't get any of your taxes back. If you want to avoid the Vorabpauschale and learn 9 other ETF mistakes that could cost you thousands of euros, watch our full video linked below and right here. Because whether it's hidden costs or hidden taxes, they all eat into your returns, so you can't afford to ignore them if you invest here in Germany. Have you ever bought a US stock or something from your home country and thought, great, I only paid the share price? What if I told you your broker might have charged you another fee without ever calling it a fee? That's what happened with foreign exchange fees. Every time you buy or sell in a currency different from your account, like a US stock in a euro account, your broker has to convert the money. The trick is, Neobrokers rarely show it as a separate charge. Instead, they bake it into the exchange rate. The market rate might be one thing, but you get a slightly worse rate, and the hidden difference goes straight into your broker's pocket. Buy $10,000 of US stocks with a 0.25% markup, and 25 euros is gone instantly. And for other currencies, it can be 0.5% or more. If you trade often or get foreign dividends, these little cuts add up fast. To reduce the damage, trade in your account's base currency when possible, so euro for most of you. Choose brokers with low forex markups. And definitely check the conversion rate before you click buy. Sometimes the real cost isn't in the stock itself, it's in the currency. And if you think currency fees cost you a lot of money, wait until you see these 10 ETF mistakes most investors don't even know they're making. Remember, investing is not just about making money, it's about keeping it. So thank you for watching und bis zum nächsten Mal.